Right. Let's make a start on this. This is the video 3 on the Robbie question, right? So we're just going to focus on completing this balance sheet on here, right? Not too sure that I need the mic for this. Right. Hope you can hear me clearly. Right. So we're just going to focus on completing the balance sheet on this part, right? So this is what the populated balance sheet which has been given to us, right? It is given to us as a opening consolidated draft of the opening consolidated statement of financial positions, right? So for this, I just need to go to exhibit start of the questions to get the things much clearer. So if I just go to the email of the email that I've received from the uh, finance director, and if I read this particular paragraph, I do it slowly, right? And here you can see the consolidated statement have not yet been prepared, but our accounting software has added together the individual statement of financial positions of Robbie and Hale, right? So what they have done, these are the word individual statement of financial positions. That means separate financial statements prepared by Robbie separately. Hale's accountant prepared their financial statements separately. But what our software did, they just merged those together, right? But there are certain items that need to be ignored or removed when you merge, right? We will come back to it in a minute. And more importantly, which you can use to show how the goodwill in Hale and joint operations will be accounted for as at 31st May 2013, right? So the balance sheet that we're going to prepare is for 31st of May 2013 to start with. That's the starting point for us, right? Let's come back to this. So now we know we're going to prepare the balance sheet. This is the statement of financial position, right? This is the statement of financial position. Let me quickly, let me quickly go back again to get the requirement clearly so that we know that we are addressing the requirement correctly. So, right, right. So this is where it says using pre-populated spreadsheet response option pre-populated spreadsheet response options, along with Exhibit 1, 2, 3, adjust the spreadsheet in order to prepare updated consolidated statement of financial positions as at 31st May 2013. I like December. 31st May 2013. So this spreadsheet, this balance sheet, this is my balance sheet, right? I'll write it here. This is my uh, as at as at 31st May, right? As at 31st May. Um, 2013, right? A statement of financial position, statement balance sheet, statement of financial position. This is what I'm going to prepare now, right? This is what I'm going to prepare, right? To start with, this is balance sheet. I have inserted additional columns here, right? I have inserted additional columns. The advantage of inserting additional columns rather than having, instead of you can simply have like this, and you can simply have plus minus, and then you can do it straight away by having an additional column like this with the subheadings, with headings, it's much easier. Then you can marker can easily see your work, right? Okay, right. So let's make a start. So we know this is the balance sheet, and more importantly, we understood how this balance were prepared, right? They said this they have an accounting software which merge to separate financial statements together, right? So we know when you merge the separate financial statements together, in particular when you say, I'll write it here. So in particular, say we have a subsidiary accounts and we have the parents accounts, and if you're gonna add them to get the consolidations balance sheets, right? There are certain items that we would ignore. We have to remove. It's there in the chapter 11, right? One of the item is that the investment that the parent has made in the subsidiary, right? Investment in subsidiary must be removed, isn't it? Why? Because that is a one clear line that you would there's an activity in chapter 11 on this, right? There is a one figure. This one particular investment figure would represents all the assets and liabilities that we purchased in the subsidiary, because this was done by the parent, right? Parent on parents book, it's only done by the parent accountants. So in that book they can only show how much asset they have in terms of their investment on the subsidiary. This is subsidiaries book. So when you're gonna merge them together, like the accounting software did, when they merge them together, what they did was they accidentally say they had a figure here. Say that there was a figure of 56 there, right? And then they accidentally, and on the subsidiaries there was nothing there for the investment, so it picked up consolidations as 56, right? This was wrong, isn't it? Why? Because this 56 that you're going to have, I'll come back to the transactions in a minute, right? The figure that they're going to have in the investment figure is actually represents all the assets and liabilities that we purchase from the subsidiary, right? This one figure represents the assets and liabilities. So it would be wrong for us to have that particular figure on the consolidations as well as individual assets and liabilities. So it would end up as double counting, right? So there are few figures that we need to remove. Let's first, as a first step, let's remove those figures, right? The first step is, as I said to you, investment in the subsidiary that need to be removed, right? But then it is a bit complicated to start with that particular transaction. Why? Because the other entries, like here, they have only recorded the cash considerations. They haven't recorded anything with respect to contingent considerations or deferred consideration. Those entries need to be done before we remove them, right? I'll come back to that as my third step. So on the first step, I can remove those easy bit from the um, balance sheets, right? The one of the easiest thing, out of the share capital, this share capital of 255, it has parent share capital and subsidiary share capital added together. And we know when you prepare consolidated financial statements, consolidated financial statements are prepared by the parents to parents shareholders. It is nothing to do with the subsidiary. It is prepared by the parents to the parents shareholders. So what we needed here, only the parents shareholders capital and not the subsidiary shareholder capital there, right? So that's one way of explaining why that we need to remove. So I need to identify how much within this figure is the subsidiary's share capital, and that need to be removed, right? Let's see, let's identify that figure. So if I just look at the statement here, exhibit 2, because we were told to use exhibit 1, 2, 3 to get these answers, right? So one of the statements here in the second paragraph, and it says it started from here. I don't want this. On the acquisition date, the carrying amount of the net asset is given 130 million, and then this is what I was looking for, the ordinary, whose ordinary share capital is this? This is the subsidiary's ordinary share capital, right? So the subsidiary's the hail subsidiary's ordinary share capital was 80 million at that date, and also retained earning also 50 million. So there is an opening balance there, 80 million and 50 million there, right? These two figures should not appear, right? These figures, 80 million here, these figures should not appear on the on the consolidations account, right? The share capital should not appear on the consolidations account, and also the 50 million retained earning also should not appear on the consolidations account. There's a reason why this 50 million should not appear, because this 50 million, we don't own them, they had it before we purchased them, right? The subsidiary had this before we purchased the subsidiary, right? So when I say we, Robbie, right? So this also should not appear. What should appear on the consolidated is the consolidated retained earnings, parents retained earnings plus whatever the retained earnings that we're going to receive from the subsidiary, post acquisition. That is the figure that we should be adding, not the whole bit, right? Because we do not own this. So first we need to remove the 80 million from this balance sheet, right? Let's remove the 80 million from the balance sheets, and that need to be removed, right? So we're removing 80 million. Why? Because it is subsidiary share capital, right? SC subsidiary share capital. I'll remove the first one. Then also, I also need to remove the retained earnings, which is 50 million. And that retained earning figure of 50 million also need to be removed, right? Let me see the volume. Yes, right? So that also need to be removed. 50 million of retained earning also need to be removed, right? So that's done. Right? That's also need to be done. 50 million retained earning also need to be done. Let me put this also in red color, otherwise you'll be upset with me. It's already there. I don't know why I put additional red here. this the next 80 was coming up. Right, right, so it's playing. Right, okay. So that's done. So I have removed these two figures. Why? I remove the share capital because share capital should not be there in the consolidation. Subsidiary share capital should not be there in the consolidations. Only the parent share capital should appear. I'll remove the retained earnings, right? The opening retained earnings of that belongs to the subsidiary. When I say opening retained earnings, what the retained earning that the subsidiary had when we purchased it at the date of acquisition. That should not appear in the consolidated financial statement. Only the consolidated retained earning that should appear, not the subsidiary. So that also need to be removed, right? So we remove these two figures, and then the next one that I need to remove is actually the investment, right? So now we just need to read a little bit further to understand this. What is this 56 and what the breakdown of this 56, right? So let's read this to get the, we have already done the goodwill calculation. So it will be helpful for me to, I will be referring back to this to explain, right? Let's read this through. So to start with the first paragraph, it says, the purchase consideration comprised of 50 million payable on 1st June 2012, right? And 24.2 million payable 31st of May. So this is deferred considerations, and a further consideration, which is a contingent considerations, was considered. So this is the key line. Only the cash considerations paid has been accounted for in the Robby's individual financial statement. So only this 50 million has been accounted for, right? So now if I just come back to the balance sheet, right? So you can see what is the double entry. What is the double entry when a parent company on its individual financial statement, when they invest in a subsidiary, giving cash, so cash will be credited from their account. So because they have done that 50 million in their accounts, so cash is credited 50 million, debit would go to the investment in subsidiaries account. That's why this 50 million is there, right? This 50 million is there. I can break this down into two. This 56 million, right? This 56 million can be broken down. I'll write it here. This 56 million can be broken down into two, right? So the first part of this 56 million here, right? First part of this 50 million is related to cash consideration. And then there is another 6 million. We'll come back to that 6 million in a minute, right? So now we understand that there is a 50 million there within this transit, the 50 million, but the accounting entry, I should not be worried. I don't have to recognize this 50 million in my books. Why? It has been done. That's what they say. They have only recognized this 50 million. Only the cash consideration paid has been accounted for. They have already accounted for. They have credited the cash account, debited the investment account in their own account, right? That has been done. So I shouldn't be worried about it, right? But now I need to record my double entries. Why? What I'm trying to achieve next, I want to find out what is this total investment figure that I need to remove from my books. The three entries need to be removed. I remove the subsidiary share capital. I remove the opening retained earnings from the subsidiaries opening retained earnings, subsidiaries share capital. And I also need to remove on the parents book, there is an investment on the subsidiaries, the investment at cost in the subsidiary. That figure need to be removed. So to remove, I need to know the total amount first, right? So let's now, the next step would be, let's process our goodwill entries into this books, right? Now we've done this in my earlier video. If you haven't looked at this video, please look before Christmas, right? And so this is the video, right? Oh no, sorry. Right, this is what I have with respect to goodwill calculations I have already done, right? So in this calculations, we have already done. If you have, please refer back to the goodwill working. I've got 3 videos on this. So we know these are the entries to start with. Considerations. Now I'm trying to process the first 3 entries into, right? I'm trying to process these first 3 entries, but I said the first entry has already gone in. 50 million has already gone in. That's why I kept a different color. Deferred considerations, we said why it is 24.2 in 2 years time. So we discounted it by 2. And this was 2 years time when, as at 1st June 2012, right? See, we are preparing accounts for 13, right? And we are preparing accounts for 13. So this would end The 1 year, exactly 1 year, no? Exactly at the end of 1 year, we expected to do this, right? Let's move on. Okay. So now I need to process these double entries, and that's what I just need you to do. First, let me process them, how it would appear on the individual financial statement. So I can get these investment total correct figures, right? So to help you, if you're weak, if you need help with the double entry, what I have done, I've written the double entries here for you, right? So it saves a lot of time for me. So if you look at the individual statements, right, let me be very clear. If you look at the individual's investments, right, so this is how the double entry would look like from the individual's point of view, from the separate financial statements of the parents' point of view. Parents would have spent cash, he would have credited cash, 50 in green because this entry has gone in, right? And deferred considerations that need to be paid. So it will be a deferred consideration, should be a liability, is 20 on liability, deferred considerations. We know these deferred considerations. We are preparing these books at the end of the balance sheet day, 31st of May 2023, right? This would appear, right? This deferred consideration would appear, see, I've already done it. This would appear as a current liabilities, right? Why? This will appear as a current liability. The reason why? Because yes, we promised them to pay in 2 years' time. But when did we bought the subsidiary? We bought the subsidiary on 1st June 2012. But we are preparing the balance sheet is for 31st of May 2013. So when you look from this date, if you stand from 31st of May 2013, the 2014 is just 1 year away. So it has to be a current liability, right? So we have to credit the current liability, deferred considerations, current liability 20, and then the contingent considerations. The fair value of the contingent considerations was 40. We have already done it in goodwill calculations. So that need to be credited, right? It was 4 years away, so it has to be a non-current liability. So I'm going to process these entries first, right? So the way that I'm going to process these entries, first I'm going to do them on the individual financial statements, right? So that I can get the right amount of this investment, because they only partially they recorded the investment cost. So my first entry going to be, right? My first entry going to be, so with these individual financial statements, I do not have to record this 50. This 50 is already there. Within 56, the 50 is there, but I need to record this 20 and 40. Let me do the 20 first. Contingent consider 20 is a deferred consideration, right? So I'm going to add 20, which is a deferred consideration, right? Which is uh, 20, which is deferred consideration, right? I've added 20, which is deferred consideration, right? And that's done. And then what is the double entry for the deferred considerations? The double entry would be, say here, individual financial statements, it will be debit the investment in subsidiaries, debit in the investment in cost. That means on the parents account, debit in investment in cost. And then the credit gonna be current liabilities, 20 million contingent considerations, right? So under the current liability here, first I would have a 20, and this 20 gonna be deferred, right? And I'll come back to the other condition in a minute, right? So the first 20 is deferred consideration that I have, right? I've recorded the 20 as deferred considerations, right? I'll put C. I'll write the definitions in clearly so that you know what I've done, right? Considerations done. So first entry I have done, debited investment in account, credited the deferred consideration, which is a current liability, right? Which is due in 1 year time, because we are at 31st of May now. Right. So the next entry is the contingent consideration. So what is the double entry for this contingent consideration? So the double entry for this contingent consideration is what? We would debit investment in subsidiary account. Credit going to be the contingent consideration. I'll repeat again. I would correct this double entry in a minute, right? Because we are trying to get the right amount that need to be appear in the individual financial statement first. So I will debit the 40 million here, which is here, right? I will debit another 40 million, which is contingent, right? Which is contingent consideration, right? Contingent consideration, debit 40 million. And then credit gonna be contingent liability, which is a long-term liability. I've got this here. Contingent liabilities credited 40 million, which is a long-term liability. I put a plus there. Then you will know why. contingent liability, which is a long-term liabilities that I have, right? So I've got that. So that's done. Now I need to move to check whether I have done my double entry. So these are the three entries that need to be, with respect to, I need to be done. So this entry 50 million already gone in. That's why they have the 50 million here on the spreadsheet. They have already a 50 million, right? So that's why the 50 million is there. And then the other two now I have processed. Remember, double entry, I need to have two entries, debit and a credit. So if you add them up, my total investment, this is my total investment. And this is the total investment in subsidy, investment at cost, investment at cost in subsidy. Now, this figure is to be removed, right? Because we know we can't have the total. If you add these total investment in subsidiaries, I'll write it here. And so if I add these up, it would become, we had 50 million, which was the cash, and then plus we have 20 million, which was a deferred consideration, and we have 40 million, which was the which was the contingent consideration, right? So these figures, now we know these figures, right? These figures need to be removed from the balance sheet, right? These figures need to be removed from the balance sheet. 1110 minus, right? These new figures need to be removed from the balance sheet, which is 11. I'll put a minus on the top, right? Why? Because otherwise it will end up as a double count. This is the starting point, right? So we remove the share capital, we remove the subsidiary share capital, we remove the subsidiaries opening retained earning, and also we have to remove the investment in the subsidiary, the total amount, right? Because they have recorded only 50. For the 6, I will come in a minute, right? So now let me suppose now if you have a good knowledge of double entry, now you would get a doubt, right? Why? Because we put the double entries are like this, and we had the double entries are, we credited the respective liability account, deferred consideration, contingent consideration, or cash has been credited for cash, but the debit was in the investment account. So now I'm asking you to remove that debit away from the balance sheet. Then that means that only one entry is, only credit entry is on the balance sheet. Then the debit is not balancing, right? So your balance sheet should not balance. This is what you should, if you think in that way, then this is what you should, the question that should come in your mind, right? So the reason for this is this. Now let me, when it comes to consolidations account, the actual double entry for this cash, the actual double entry for this would be debit the goodwill account and then the credit all these cash credited, deferred consideration credited, contingent consideration credited, right? This is a double entry. So for these three entries, debit is in the goodwill account, right? So this is how it balances. So if you just go to the goodwill account, you see this is the goodwill that we calculated. Within the goodwill account, we debited these three entries. So in the consolidations book, debit the goodwill account, credit the respective account is the right double entry, right? It's a correct double entry. That is why, even though I recorded two entries here. I recorded the double entry credit entries here. I recorded the debit entries there, individual onto account. Then I removed it. So it appears to be like I have only one credit entry, but actually the debit entry is hidden in the goodwill account. Whatever the item you're getting from the subsidiaries are hidden in the goodwill account, right? That's why the debit is there. Now everything has been done. And there is one more entry here. I need to remove this 6 million. I'll do it when I reach the end, when I do the what do I call the IFRS 11 12, which is it, joint operations, right? That's done. Now I've done these two entries. I've done this. Now I need to move on to record my next entries, which some of item was not there, right? Right, now let's move on. And this is another entry, which is related to contingent liability. Right, let me also show you this contingent liability entries here. Then once it is done, we take one step at a time. Right, now I have here, this is about the deferred contingent consideration. And if you read this line here, the second paragraph, what was the item, right? I'll explain it like this. So it's much easier. You can see here the steps that I have done, right? I've clearly explained you that's 60, and then which is the cash paid 50 already recorded there. For explanation is here clearly, right? I've given you clearly why we are removing it, all there for you, right? But remember, the in the consolidations book, the right double entry is debit goodwill, credit these three entries, right? That's the correct double entry. That's why even though the credit is there, the debit is missing in the consolidation, it's balancing because we have already taken the goodwill into books. That's done. So now the next thing I just need to consider here is the contingent consideration. Contingent. So they said that on 1st June 2012, the fair value of the contingent consideration was measured at 40 million, right? So remember this here, there is a contingent consideration, meaning what? We promise to pay them if they reach if their profits in 4-year profit, if the subsidiary hit 150,000 or more, I would be giving them an additional 2 million, right? I would be giving them 40 million in cash. So this contingent liability, the fair value of this contingent liability is normally based on the probability, the how certain, what is the chance of that subsidiary hitting that profit. So when I first bought the subsidiary, it was very remote. We thought they would have chance of only 40. It is only 40 million that we have to set aside funds. That's how we think they're going to hit the target. But when I reached the year end on 31st of May 2013, now things have just bit changed. Now it's looked like the subsidiary have a better chance than before when I first purchased. So as a result of it, my fair value has increased. Now you have to be very careful when you deal with this. You just need to understand the rules regarding this. I think I have pointed out one of the other videos when I did the goodwill, I pointed out this, right? I've added the respective slides for you to understand. So when there is a contingent consideration, and then that contingent consideration can be promised in two ways. We may have promised to pay them in cash, or we may have promised to pay them in shares, right? But if we have promised to pay them in equity, shares, that means the remeasurement, no need, not required. So we don't have to worry about the remeasurement. But suppose if we promise to pay them that contingent liability, contingent consideration, apologies, if we have promised to pay the contingent considerations in terms of cash, then a remeasurement need to taken into account, right? But more importantly, this remeasurement will not affect the goodwill account, right? Because why? And I hope you remember the something that we learned on measurement period, right? So even though it was within the measurement period, that means within 12 months of the date of the purchase until now, right? Within 12 months of date of purchase, if we have any additional information to point out that we made a mistake with respect to estimated figures earlier when we did the goodwill calculation. So we were using a provisional figures then. In that case, it would be necessary for us to go back and change a goodwill calculation. But here it is not the case. They haven't said anything. It is simply based on the performance, right? Now we think they're going to hit the target more likely than before. So this is simply based on the performance. The fair value has increased, right? So in this case, it would not impact anything on the goodwill account, but we have to increase our liability, and then the debit need to go to the profit and loss account, right? We need to reduce the profit and loss account. I think double entry is somewhere here on the contingent liabilities. Right, I think this is contingent considerations. Somewhere I'll show you. Yes, this is the contingent consideration. I've just skipped some steps. Don't worry, right? I will be, I'm doing it in a way that it's easy for me to explain, right? So this is a double entry for that contingent considerations. We already recorded these contingent considerations, and we already done this contingent consideration. We have already done it. And this is deferred, sorry, this is deferred considerations. I'm just looking for contingent considerations. Yes, this is the contingent consideration, right? Contingent considerations, we have already done it, right? So now what we need to do, we need to increase that contingent consideration. So we need to increase, right? Why? Because the fair value has gone higher. It would not impact any goodwill. So credit going to be contingent liability, right? Credit going to be contingent liability because it is due in 2016. So I need to be crediting 2 million in the contingent liability. Debit is going to come out from my retained earnings, parents' retained earnings, group's retained earnings, right? So I need to go to my balance sheet, credit contingent liabilities, right? Long-term liability. So I already have a contingent liability of 40, right? Contingent consideration of 40. And with this figure, right, contingent consideration of with this figure, I just need to add another 2 million. Why? Credit the contingent liabilities, right? Increase, right? Increase in contingent liabilities, 2 million credited. And then the debit gonna be from the retained earnings. So I need to be removing the contingent considerations from, actually it should be here rather than there, because I'm having recognized contingent liability. So let me remove this from there to here. It's much better, but I don't have enough space. Never mind. But here, one of the item here should be contingent, contingent liability, right? Increase. It's increasing, you know, contingent liability is increasing, right? It's increasing. So one of the item is contingent liability, which is increasing, right? So that need to be increased, but it's related to this paragraph rather than for the other, right? It's related to here. So how much is going to increase it? By 2. So when it increase, I need to reducing it from my retained earnings. And let me say the double entry again. What is the double entry? Credit the contingent liability, which is a long-term liability, credit long-term liability, credit in the sense I'm adding, so I've increased it. So the money has to come out from the retained earnings. So debit retained earnings. So I have reduced the retained earnings 2 million, right? I hope it's clear. Credit contingent liabilities, debit, because contingent liability, when you profits are credit balance, retained earnings are credit balances. I need to keep debit means I need to remove them. So I reduce 2 million there. I hope that's clear. So that's done. So I've done the contingent liabilities. I have recorded this. That is done. Net assets, everything there in the goodwill account. So I don't have to worry about it. Now, the only thing I need to record here is the goodwill account. You know? So now we have a problem again here. Why? Because, you know, this goodwill account is for 1st June 2013. You know? But I need the goodwill account for when? I need it for 31st May 2013. This is what I need the goodwill account for. But here in this questions, there is no impairment of goodwill is given, right? There is no impairment of goodwill. There is no impairment of goodwill is given, right? No impairment goodwill is given. So goodwill at the start date and the goodwill at the date of the balance sheet are the same. Reporting date goodwill are the same, right? This is the goodwill, right? Goodwill at the reporting date, goodwill at the reporting date, they're the same, right? They're the same 12 million. So I record the goodwill. So the goodwill, I just need to add the goodwill here under the goodwill account 12. Right now, you may ask, I need to add a line for goodwill because there was no line, so I added goodwill. So now you may ask that where is the double entry for this 12 million, right? Where is the double entry for this? I've done the debit goodwill account, and where is the credit for 12 million? That credit is what is this, right? If you add all these up, that is what the credit is for, right? Debit goodwill account, and then the credit. Remember, I said to you earlier, these entries here. See, all these are credit, 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 and then there's a net assets debit. You would get the goodwill, right? That's a double entry for goodwill. I hope it's clear. I'm not going too fast, right? If you have any questions, you can please drop an email and ask me. No problem. You can call me. Right, that's done. We are done the first part of it, and let's move on to see the other. Right, there is another item that we have. We recorded is a deferred considerations, and then we recorded a deferred consideration here. Let's go back to the deferred consideration, which was a current liability. We said this is what a deferred consideration is. Right. Let me show you the double entry for deferred considerations. The deferred consideration was somewhere here. What's the deferred consideration? This is 3. Yeah, this is contingent. This is deferred, right? So deferred consideration here. Initially, I recorded it. Remember, I told you the double entry. Debit would have gone to the goodwill account. Credit is the deferred consideration, which is a current liability. We have done it, right? We did this as a current liability. We did this, right? This is a current liability. Now, what happens here? We know initially the money owed, how much we owed to the other party in 2 years' time, it was something around 24.2. And this was the deferred consideration, right? This is the money not due now in 2 years' time, right? So that's what we do. It was a starting date. And when we discounted this figure, this 20 million was processed on the first day when we bought the subsidiary, 1st June, right? So now we are not at the 1st June. Now we are at the 31st of May 2013. That means we are at the reporting day. Now remember, what is a definition of a liability? Liability is the present value of this future obligation. So that is why I've discounted this 24.2. If I just go back to show you the deferred consideration here, say here, I've discounted this 24.2 and then declared a present liability, right? So this is my present liability. So whenever we're going to discount a figure, right? Whenever we're going to take a discounted figure in our balance sheet, right? So whenever we're going to have a discounted figure on our balance sheet, right? Here, right? Whenever we're going to have a discounted figure on a balance sheet, then we should know that an unwounding need to be done, right? Unwounding need to be done. Unwounding is where that, the reason is this. Now I'm standing at 31st. No, initially I started from 1st June, right? Initially I started from 1st June 2012, right? At that day where it was 20 million, which was the deferred consideration. I measured the deferred consideration on this day. I find the present value. I find the present value is equal to 20, right? Which was deferred. This is what I have got the 20 million from. But what has happened from here to here, it's 1 year, right? So starting from this period, when I reach 31st of May, 2014, that is the actual liability I need to pay on that day, right? That amount is not due now, right? I promised my subsidiary that I would pay them in 2 years' time. It is not now, right? But in my books, because of the accounting standards, I have to declare this figure at this present value. So I've discounted it. So what I should be doing every year, I have to unwound. That means there is a finance cost charge I need to create, and I should be increasing this figure from this year 20 10%. I would add this up, and I should be reporting on 31st of March as a 22 figure. So next year, when I move to 2014, when I reach 2014 here, I'll show you, it is not in your books. It is not in this working. So if I reach to 2014, right, I should be charging 10% of this 22, and this would be 2.2, and then plus 22 already there. It will become 24.2. That means when I reach 31st of March, right? When I reach 31st of May, sorry, sorry, when I reach 31st of May, when I reach 31st of May, the figure should appear exactly the same as the liability figure, right? That's the purpose of unwounding, right? So because I've discounted it, so every year there has to be a finance charge need to be added on to my profit and loss account, and my liability should be increased by that discounted percentage, so that when I reach the final year, that figure should be equal to my liability figure that when I first discounted it, right? So that unwounding need to be done. So we know we just reached 1 year gone. So that 1 year of 10% need to be unwound. So unwounded means what? I should be increasing my liability. Unwounding means I should be increasing my liability, right? So unwounding is where I should be increasing my liability. Or I can write the double income, just like it's here, right? So when I increase my liability, I have to credit the contingent deferred consideration liability, and then I will be debit the profit and loss account. I'm increasing my liability by 2. Why? 1 year has gone. So whatever discounted, now my liability should not be 20 anymore. It's 22 now, right? So that need to be done. So that double entry, 2 million need to be under deferred consideration. Liability need to be increased by 2 million, and my retained profit need to be reduced by 2 million, right? So deferred consideration here, this should be increased by 2 million. Why I'm increasing by 2 million? Because it is simply because of unwounding the interest, right? Finance cost, and then therefore a finance cost should be there in the balance sheet, right? So it should decrease. 2 million should be decreased from finance cost, right? That has been done. 2 million has been done. So retained earnings has reduced 2 million. So I've done these two entries, and then I've done the deferred tax, and then also I've done the more. I think the next what I have here with respect to this, I've got the controlling interest there, non-controlling interest done, 30, and what else I have to do? I think with respect to consolidations on the disregarding joint operations, I think most of the transactions I have processed them through. Unwounding as done. No, one more contingent liability which need to be done, right? Now, if I just go back again here, there is there is a one item here which is says contingent liability, right? It is a contingent liability. So what has happened with respect to this contingent liability 2 million? If I just read the note here, right? It's the contingent liability. It's here. So it says the notes to financial statements of Hale. Hale is a subsidiary at the acquisition disclosed at contingent liability. So I think I've explained this in detail when we did the goodwill calculation. This contingent liability, Hale's individual accounts, when they prepared, their accountants were following IAS 37 provisions. Based on the provisions, they looked this to be too remote and unable to reliably measure. So they thought it need to be recognized as a liability, right? It is not being able to measure properly. So they thought it is need to be recognized as a not as a liability, as a disclosure note to the financial statement. So that was they did. But when we're going to prepare consolidations accounts, we don't follow IAS 37. Consolidations, group accounts would override IAS. The IFRS 3 business combinations override the IAS 37. So the instructions we need to follow is not IAS 37, but IFRS 3 business combinations. So according to business combinations, provided the fair value of the contingent liability can be reasonably measured, right, can be reliably measured, right, and this need, provided there is an obligations there, contractual obligations, and also this figure could be reliably measured, this contingent liability need to be recognized in our books in the subsidiaries balance sheet. So what is the double entry for this contingent liability? So the double entry here for this contingent liability is this, right? See, this is the, I've given you clear explanations. The double entry for the contingent liability going to be, we should be crediting the contingent liability account. Debit should go to the goodwill account. See, this is what we have done. See, debit is here, right? Debit is where, because this is the goodwill account, right? This is the goodwill account. Under the goodwill account, liability is there, and we are reducing the liability. Reducing the liability and having two here is the same impact. And when you reduce a liability, goodwill gonna increase, right? Say for example, if I just take this off, if I take the 2 million off, you will be able to see. Oh, this on. I thought these are figures. I'll change it and let me change this again. So if I just, for example, from here, right here, right, let's, earlier there was a negative 2 here, right? When the, come on, change it. This needs to be right. See, right, now change. Let me do this. Say if 2 million was not reduced, my goodwill was 10, right? If I reduce the liability by 2 million, you can see my goodwill is increasing by 2, right? So the impact is debit on goodwill account, isn't it? Goodwill is increasing, debit on the goodwill account, right? So if therefore, the double entry here for me, debit in the goodwill account means good, I have a one figure for goodwill. So this entry of 2 million has already been taken into account. So I do not have to worry about the debit entry. It is within the goodwill account. So credit is what I should be worrying for. Credit entry is 2 million. I need to have a contingent liability, right? Contingent liability. I have a 2 million contingent liability. This is a contingent consideration, right? This is contingent liability. This is 2 million liability increase. 2 million. This is contingent considerations. So words. Right. Here, this is contingent considerations that we have. Okay, right. So I have done these two. This is contingent. Yeah, I like to show this. This is the earlier one, contingent consideration. Now this is really now the right figure for contingent liabilities. I should be increasing by 2 million, right? I hope clear. The earlier 2 million here is for the contingent consideration, which is the increase in contingent consideration. Debit on the non-current contingent consideration. Sorry, credit on the considered considerations, debit from the profit and loss account, retained earnings. Now it is a contingent liability, credit on the non-current liability, which is contingent liability, but then the debit is on the goodwill account. We have done it already, so the entry has gone. I'll come back to the BPP solutions in a minute, right? So I have done this, all done. Unbounding finance cost, everything has been done. And so provided now I just got only, I think I have only got left, which is the joint operations, right? So now let's come back to the joint operations. When I look at the joint operations here, it is very clear that sorry, if I just go to the joint operations slides, I don't need this now. Take this off. I need the joint operations slide. Right. This is the joint operations slide. Exhibit. Right. Let's look at the joint operations exhibit. So when you look at the joint operation exhibit, they're saying Robbie contributed 40% of the cost of constructing a natural gas station and then 40% shares in the gas station as a result. You know, it is a joint operation. Because a joint operation, we should be taking rights for individual assets and liabilities, right? So no separate entity was done. And more importantly, natural gas was there. I'm looking for that word. So this is the last line. The only accounting has been taken place to date is to record the investment in joint operation at 6 million in the individual statement of financial position. So it is wrong to have an investment in account in the consolidations books. Why? Because joint operations, individual assets and liabilities would be added to the parents or the separate financial statements, right? Nothing would be, it wouldn't, there won't be no impact when it comes to in the investment in joint venture is an equity accounting method, you know, that is for joint venture. So for joint operations, each assets and liabilities, like we do consolidations, I need to be added to the parents' assets and liabilities. So this was wrong, 6 million. That was wrong. So that figure need to be removed, right? So that's why that 6 million was there. But then you would have a doubt of double entry. That double entry, I would explain in a minute. So this 6 million simply, this is for the joint operation investment cost, right? Investment cost that need to be removed. Now, if I remove this, sorry. Now if I remove this, you would find it easily. So what I have it now, this is, I have, see, this is 60 and 56 is 56, 60 is 100 and, this is 60, 116. And so I have minus 116, the figure is 0, right? So joint operations, what is left? Now I need to record my joint operations accordingly. To start with this first. So I've already done all this part. I need the figure on my balance sheet, 31st of May 2030. I have an asset, which is the PPE from the joint operation 613. Because it's the joint operation, that need to be added to the parents book, right? So I just need to add this to 61, I think it's 612, and that need to be added to the parents book, 612, right? That needs to be added to the parents book. This is 612. That's done. And then thereafter, what I should be doing thereafter for the joint operations, you know, because this one of these cost was dismantling cost, and it's like a discounted figure. You know, we're gonna close this up, so I have to put down whatever the settings and structures, right, when I reach the end. But there is a cost for dismantling. What I'm supposed to do now, I need to like IAS 16, we need to discount it, and then that discounted figure need to be capitalized. That's what I have done, because I have discounted the figure. So now, so there is a process I need to do to unwound this discounted figure. You know? So as at 1st June 2000, the dismantling provision, I would have 0.8. So when I reach the 31st of May, I need to unwound. I need to add a finance cost. So the finance cost will be 5%. It is given in the question of 0.8. That's 5% of 0.8, 0.04. Total dismantling cost on the balance sheet will be 84, right? So dismantling cost is the 31st May 2013. Liability is 0.84. The liability would be increased. It is the 0.84, which is long-term liability. It will be increased by 0.84. It is related to uh, dismantling, right here, dismantling cost provision, dismantling cost provision. That's increase. You don't have to write like this. I'm writing it so that you understand them easily. So now I can get that's done. So then the next one, I need to charge the 0.4. You know, this need to be charged to profit and loss account, because debit profit and loss account, finance cost with dismantling, credit the dismantling provision. So I have also done that. Dismantling provisions has been done. 0.4. That's done. That's a negative here, right? Because it's a debit to the profit and loss account. That's negative. But not only that, then this is a fixed asset, and this is a fixed asset that I have. 6.8 to start with, but then depreciation need to be charged. We charge depreciation of 6.8, right? So charge of depreciation will be debit profit and loss account, credit assets account. Asset has been carried amount to correctly. So 0. Minus 0.68 minus 0.68 is what the uh, uh, depreciation charge. This is the depreciation, right? This is the depreciation charge of the joint venture, and then this is the dismantling cost, right? This is a dismantling cost, right? That's added up to. Now you'll be able to balance. I had 110 to start with, right? 110 retained investments minus 2 million, which is unbounding finance cost, minus 2 million, which is the increase in the contingent considerations, minus 50. Remove the subsidiaries retained earnings, minus 6.8 plus minus 0.04, total up to minus 72, comes up to 55.2. Now, if I just try to balance this out, you can see the total balance I have here is 69.12. And then if you add everything up, you should get a figure of. So this was 175. That means 255 minus 80. This is 12, which is the other components. No change here. 55.8, I've already shown this. 30 is amongst NCI. Dismantling costs, I've already done this. 75 non-current, 40 contingent consideration, plus 2 increase in the contingent considerations, and plus 2 contingent liability, and then plus 0.84. And then unwounding, 55 non-current, other current liability, 20 deferred consideration, and 20 is unwinding finance cost. If you add them up, that should come up to 69.2, right? Now, while I'm here, I would like to, I can show you, because you can see here, I've pointed out something here. Right? If you watch, please. And at the end of the BPP's book, if you watch carefully, they've uploaded the video. There is an error in the solution, right? If you watch carefully, you would find the error. If you watch carefully, the way the presenter's video, even though this is a contingent liability, this is a contingent liability column, which was 2 million there, and in that video when they presented, she would be she is it's common to make mistake in this kind of question. So instead of saying this is contingent liability, because they're missing a transaction here, right? They're missing one transaction here. So instead of saying this is a contingent liability, right? What she's saying this is the increase in deferred consideration, right? So right, so there is one double entry that is missing. It is balancing up because the complete double entry is missing in that solutions, right? Just carefully, if you watch carefully, then you will understand the difference. Thank you. Right, I stop.